Welcome to our deep dive into the sophisticated world of institutional investing. Today, we're unveiling the strategies employed by limited partners to navigate the intricate global private markets. This video is for anyone seeking to understand the complex dynamics of private equity, venture capital, and private debt from an institutional perspective. Whether you're an aspiring finance professional, an existing investor, or simply curious about how large endowments and pension funds manage their vast portfolios. By the end, you'll gain a comprehensive understanding of how LPs approach allocations, manage liquidity, select fund managers, and tackle the myriad challenges in this evolving landscape. Get ready to enhance your financial literacy and discover the nuanced approaches that drive significant capital in the global economy. Please note, this video is for educational purposes only and not financial advice. At the heart of the private markets ecosystem are limited partners, or LPs. These are the institutional investors who commit capital to private equity, venture capital, real estate, and other alternative investment funds. Unlike general partners, or GPs, who manage the funds, LPs are passive investors, providing the capital in exchange for a share of the profits. But who exactly are these powerful financial entities? Limited partners primarily consist of large institutional bodies. Think pension funds, university endowments, sovereign wealth funds, insurance companies, and family offices. Each type of LP brings unique characteristics and motivations to the private markets, but their collective goal is to generate strong, risk-adjusted returns to meet their long-term liabilities or mandates. Their primary motivations for allocating to private markets are compelling: the pursuit of higher returns, often outperforming public markets over the long term, due to the illiquidity premium and active management. Secondly, diversification. Private market investments offer exposure to different economic cycles and asset classes, reducing overall portfolio volatility. And finally, long-term growth and capital appreciation, aligning with their extended investment horizons. The private markets landscape is constantly evolving, influenced by macroeconomic factors, geopolitical events, and shifts in investor sentiment. In recent times, we've observed several significant trends shaping LP strategies, creating both challenges and opportunities for institutional investors. One of the most pressing issues LPs face today is the, quote, liquidity squeeze and the growing exit backlog. During periods of economic uncertainty or rising interest rates, exits, such as IPOs or M&A activity, slow down. This means LPs receive less cash back from their existing private market investments, leading to reduced distributions. This backlog can strain LP liquidity and make it challenging to fund new commitments. Adding to the complexity is the, quote, denominator effect. This phenomenon occurs when the public market value of an LP's portfolio declines significantly, while the private market assets, valued less frequently, do not immediately reflect similar declines. Consequently, the private market allocation, as a percentage of the total portfolio, appears to swell, potentially pushing LPs above their target allocation limits. This can force LPs to reduce new private market commitments or even sell existing private assets to rebalance. In response to these market dynamics, LPs are continually refining their strategies. The current environment demands a more sophisticated and proactive approach to portfolio construction and management. We're seeing a clear shift in priorities and tactical adjustments. A key shift is the increased focus on distributions to paid-in capital, or DPI. While internal rate of return, or IRR, remains important, LPs are now scrutinizing DPI more closely. DPI measures the actual cash return to investors relative to the capital they've invested. In a tighter liquidity environment, cash in hand is paramount, making DPI a critical metric for evaluating fund performance and manager selection. LPs are also actively engaged in, quote, portfolio rebalancing and, quote, pace adjustment. To manage their overall allocation and liquidity, they might slow down the pace of new commitments or even consider selling mature private assets on the secondary market. This tactical flexibility allows them to maintain their target allocations and manage capital calls more effectively, especially when facing denominator effect challenges. Another notable trend is the, quote, shift towards mid-market and niche strategies. While mega funds still attract significant capital, many LPs are finding compelling opportunities in the middle market, which often offers better value, less competition, and stronger operational engagement potential. Additionally, specialized niche strategies, such as impact investing, specific sector focus, or regional plays, are gaining traction as LPs seek differentiated returns. Effective liquidity management is paramount for LPs. Given the illiquid nature of private markets, LPs employ several sophisticated mechanisms to ensure they have access to capital when needed, or to generate liquidity from their existing holdings. The quote, secondary market has become an increasingly vital tool. This is where LPs can buy or sell existing private fund stakes. LP-led secondaries involve an LP selling their interest in a fund to another investor, providing immediate liquidity. GP-led secondaries, on the other hand, involve the fund manager restructuring existing assets into a new fund or vehicle, offering LPs the option to cash out or roll their investment. Both provide critical liquidity pathways. Co-investments and direct investments are also gaining prominence. Co-investments allow LPs to invest alongside a GP in a specific portfolio company, typically reducing management fees and carried interest on that portion of the investment. Direct investments, while rare and highly resource-intensive for most LPs, involve investing directly into a company without a fund intermediary. Both strategies offer greater control and potential for enhanced returns, bypassing some fund-level fees. Lastly, new fund structures like evergreen funds are emerging. These funds typically have an open-ended structure, allowing for continuous capital raising and redemptions, providing LPs with greater liquidity flexibility compared to traditional closed-end funds. This innovation caters to LPs' increasing need for more agile investment vehicles. Selecting the right general partners, GPs, is perhaps the most critical decision for LPs. This involves a rigorous due diligence process that goes far beyond just reviewing past performance. LPs seek partners who can generate consistent, risk-adjusted returns and align with their investment objectives. Key priorities in GP selection include assessing, quote, strong teams with deep sector expertise and a proven track record. LPs scrutinize, quote, robust processes for deal sourcing, execution, and value creation. They also look for a clear niche focus or differentiated strategy that can deliver alpha, rather than a broad, undifferentiated approach. Transparency and communication from GPs are also highly valued. Environmental, social, and governance, or ESG integration, has moved from a fringe consideration to a core component of LP due diligence. LPs are increasingly evaluating GPs not just on financial returns, but also on their commitment to sustainable and responsible investment practices. This includes assessing the GP's own operational ESG policies and how they integrate ESG factors into their investment decision-making and portfolio company management. The belief is that strong ESG practices can mitigate risks and contribute to long-term value creation. The relationship between LPs and GPs is also defined by fee structures. Ensuring proper alignment of interests is crucial to a successful partnership, and LPs are actively seeking more favorable and customized terms. We're observing a trend towards declining fees and increased customization. While the traditional 2 and 20 feet, 2% management fee, 20% carried interest remains a baseline, LPs with significant bargaining power or long-standing relationships are often negotiating lower management fees, especially for re-up funds. There's also a greater demand for bespoke fee arrangements tailored to specific fund structures or investment mandates. Performance-linked fees and clawback provisions are critical for alignment. Performance-linked fees mean that a larger portion of the GP's compensation is tied directly to the fund's actual performance above a certain hurdle rate. Clawback provisions are contractual clauses that require a GP to return previously distributed carried interest to LPs if the fund's overall performance falls below an agreed-upon threshold at the fund's liquidation. These mechanisms ensure that GPs are truly incentivized to generate strong, sustainable returns for their LPs. In summary, limited partners are sophisticated institutional investors driving capital into global private markets, seeking high returns and diversification. They actively manage liquidity, navigate market shifts, and meticulously select general partners based on robust due diligence, increasingly integrating ESG factors. As private markets continue to grow, LPs will play an even more active role, leveraging data and technology to optimize their strategies. This video is for educational purposes only and should not be considered financial advice. Thank you for watching.